Your financial advisor made more money from you this year than they did last year. Not because they came up with anything new, not because they picked up the phone one extra time, simply because the market climbed and your balance got larger. That is the entire business model. And once you actually understand the arithmetic behind it, you begin to realize there is one conversation your advisor is structurally unable to have with you, and it happens to be the most valuable conversation available in personal finance. That conversation sounds like this. You know what? At this stage, you genuinely do not need my services anymore. In 2024, registered investment advisors managed $144.6 trillion in regulatory assets under management, a 12.6% jump from the previous year, the highest figure ever recorded. The global financial advisory services industry was valued at $218.96 billion in 2025. $218 billion flowing largely from individuals who, in most cases, could legally achieve the same after-fee result from an index fund charging 0.03%, 93% below its category average. 3 cents for every $100 invested annually. Sit with that number for a moment before we go further. The purpose of this video is not to declare that all financial advisors are worthless. Some of them are genuinely outstanding, and exactly what separates those from the rest will be explained. What needs to be exposed is the structural incentive that makes the mediocre ones costly, quietly corrupts the average ones, and undermines even the best ones on one very specific point. The single piece of advice the model will not allow them to deliver, not because they lack integrity, but because the system makes honesty financially damaging for them. Here is what will be explained. The dominant payment structure in the financial advisory industry, charging a percentage of your total assets every single year regardless of results, creates a conflict of interest so foundational that it corrupts the advice before it even reaches you. The exact dollar cost of that in real compounding terms will be shown. A legal loophole that most investors have never encountered will be revealed, and the point where the industry's own justification for its fees quietly unravels when you actually run the numbers yourself will be made clear. It is also worth being precise about who this conversation is not directed at. If you are navigating a business sale, a complex estate, multi-generational wealth transfer, or cross-border tax exposure, then yes, you almost certainly need a financial professional, possibly several. This discussion is about the average investor holding $200,000 to a few $1,000,000 who is being told they require ongoing professional management indefinitely, when the evidence points in a different direction. One simple metaphor deserves to anchor everything that follows. Imagine hiring a personal trainer, not a hypothetical one, a real one. Certified, experienced, capable of building a proper program, but instead of paying per session or per hour, this trainer charges based on how much you weigh. Each month, they put you on the scale, record the number, and send you a bill for 1% of that figure. When you are heavier, they earn more. When you become lean, which is theoretically the entire point, they earn less. Now ask yourself honestly, does this trainer have any structural incentive to get you to your goal as quickly as possible? Of course not. They might be a wonderful, genuinely skilled coach, but the incentive is pointed in the wrong direction. Getting you to your goal is bad for their revenue. That is the assets under management model. Your financial advisor's income is a direct percentage of your portfolio value. When your portfolio grows, even due to market gains they had absolutely nothing to do with, they collect more. When you reach the point where you genuinely do not need them, you are still paying by the pound. That phrase will come up repeatedly because it is the clearest summary of why the guidance you receive is always, at every margin, subtly tilted away from your best interest. Not through deception, through structure. In a moment, the one legal distinction that explains why most investors have no idea what standard of care they are actually receiving will be examined. But first, the scale problem needs to be translated into actual dollars. According to the 2024 Kitches report, 92% of advisors operate using an assets under management fee structure. A $1 million portfolio carries a median AUM fee of 1.02% annually. That sounds like $10,200 per year. Already not a trivial number. But the real cost is not $10,200. The real cost is everything that $10,200 would have grown into had it remained inside your portfolio compounding over 30 years. Here is the arithmetic. Take a $500,000 portfolio growing at a consistent 7% annual return. Over 25 years without any fees, that portfolio expands to approximately $2.71 million. With a 1% AUM fee applied, the portfolio would reach only about $2.15 million, a gap of $560,000. $560,000. You started with $500,000. You just paid the rough equivalent of your entire opening balance in compounding losses, not in fees paid, but in compounding that never happened. Vanguard's founder described this phenomenon simply as the tyranny of compounding costs. Now extend that to a $1 million portfolio over 30 years and the situation deteriorates further. A $1 million portfolio growing at 7% annually with a 1% fee applied could see its final value shrink by approximately 25%, translating to nearly $1.9 million less at the end. Not $1.9 million in total fees charged, but $1.9 million in the compounding that those fees silently consumed. The annual invoice your advisor sends is the visible number. The invisible number is the one that should genuinely concern you. Here is another detail that never appears in any brochure. As your portfolio grows, so do the fees, even when the advisor's workload remains completely unchanged. A $1 million portfolio generates $10,000 in annual fees. A $2 million portfolio produces $20,000 per year, despite the fact that the level of service delivered almost certainly stays the same. The work does not double. The bill does. And since 2018, financial advisor fees have not been deductible for most individual taxpayers. The Tax Cuts and Jobs Act eliminated that deduction, and subsequent legislation has extended that prohibition beyond 2025. So you are paying after-tax dollars on that annual fee. The $10,200 charge on a $1 million portfolio actually costs closer to $15,000 in gross income if you sit in the 32% tax bracket. There is someone worth introducing at this point. Call him Marcus. He spent 12 years as a financial advisor at a mid-sized wealth management firm. Intelligent, genuinely invested in his clients' well-being, a skilled communicator. Somewhere around year 7, he began having a quiet internal dialogue that he was never voicing to the people across the table from him. He would review a portfolio, mostly diversified index allocations, rebalanced annually, performing almost identically to the broader market, and think, this person does not actually need active management. Maybe some behavioral coaching during a market crash, an occasional tax question, but portfolio management at a 1% annual fee? He later described himself as being compensated to send quarterly statements with a professional letterhead. He never said this to his clients. He could not, because if he did, they might walk away. The scale problem does not reward honesty. Marcus will come back into this story. Where his path leads is not where you would expect. Stay with this because the next section fundamentally reshapes how you should evaluate every recommendation you have ever received. 2 legal standards govern financial professionals operating in the United States. Most investors have never heard of either one. The first is the fiduciary standard. Under this standard, an advisor is legally obligated to act in your best interest at all times. Established through the Investment Advisors Act of 1940, the fiduciary standard requires that an advisor place their clients' interests above their own, follow the most beneficial course of action regardless of personal impact, and execute advice as cost-effectively as possible based on thorough analysis. They are also legally required to disclose any conflicts of interest that may arise. The second standard is called the Suitability standard. This one is considerably less demanding. Advisors operating under it are only required to deliver advice that is suitable for a client based on their financial needs, goals, and individual circumstances. Not the best option available. Not the cheapest. Simply suitable. They are not required to prioritize their clients' interests over their own, and disclosure of conflicts of interest is not mandatory. Here is the figure that should genuinely give you pause. fewer than 10% of financial advisors are held to the fiduciary standard. 10%. The remaining 90% can legally direct you toward higher cost products that generate larger commissions for themselves, as long as those products are not wholly inappropriate for your situation. The word suitable is carrying an extraordinary amount of legal weight in that sentence. Broker-dealers, insurance agents, and certain financial planners may be held only to the suitability standard, which creates the conditions for significant conflicts of interest. The suitability standard was updated in 2020 when the SEC introduced Regulation Best Interest. While it stops well short of imposing a true fiduciary obligation, it introduces stricter requirements for broker-dealers when making investment recommendations. But the enforcement gap between a best interest disclosure requirement and a legally binding fiduciary duty is precisely where a significant and quiet amount of money quietly changes direction. Here's what this looks like in practice. You have $300,000 to invest. You walk into an office operating under the suitability standard. The advisor could place you into a mutual fund charging 1.2% annually with a 3% to 6% upfront sales commission. Commission-based advisors earn a percentage of transaction value when selling financial products, with rates commonly ranging from 3% to 6% on products such as mutual funds, annuities, and insurance policies. Alternatively, he could place you in a low-cost index fund charging 0.03% that pays him nothing. Both options are technically suitable for a middle-aged investor with moderate risk tolerance. The question answers itself. This is not a claim that your particular advisor is doing this. The point is that the legal structure permits it, and you would never know, because the title advisor is not a protected designation in the United States. Anyone can use it. A broker holding a sales license, an insurance agent, and a fully registered investment advisor with a fiduciary obligation can all hand you the same business card bearing the same title. The only way to determine which category applies to the person managing your money is to ask directly, in writing. Are you a fiduciary under the Investment Advisors Act of 1940? Pay close attention to the response. This legal gap, with 90% of the industry operating under a weaker standard, is precisely where the mainstream retirement industry fails the average investor at the most fundamental level. Because even when your advisor is ethical, even when they are genuinely trying to act in your interest, the model they operate within does not align their income with your outcomes. No amount of goodwill corrects a misaligned incentive. Understanding how the fee structure works and knowing what to actually do about it are two entirely different challenges. After roughly 2 years spent reviewing 50 years of actual retirement data, including sequence of returns research, withdrawal rate modeling, and portfolio construction analysis, that material was organized into something called the Exit Code. It is a digital book, 8 chapters of pure research and mathematics, no filler, built around one central objective: transforming the question of whether you can afford to retire from a feeling into a number you can calculate yourself. The connection to this discussion is direct. Your financial advisor will not hand you a framework that reduces your dependence on them. They charge 1% of your assets annually to explain perhaps half of what is contained in this resource. 2 chapters connect most directly to what has been described here. The first addresses what can be called the 4% trap, the well-known safe withdrawal rule that many advisors still reference in client meetings, even though updated research on sequence of returns risk has seriously challenged its assumptions for people retiring early. A dynamic withdrawal method was developed to replace it, one that adjusts based on actual market conditions rather than a fixed percentage applied regardless of circumstances. The second is the lazy portfolio, a 3-fund allocation strategy with a documented performance history across every 30-year window in the available data, consistently outperforming the majority of actively managed accounts after fees. No advisor is required to implement it. You set it up once and largely leave it alone. The entire resource is available through the link in the description. It costs less than a single hour with a mediocre financial advisor, and that is a mathematical statement, not a promotional line. Every year spent without a concrete framework is a year the math compounds in the wrong direction. Now, 2007. Warren Buffett. In 2007, Buffett proposed a $1 million wager. His offer was that over a 10-year span from January 1st, 2008 through December 31st, 2017, the S&P 500 index would outperform a collection of hedge funds when measured net of all fees, costs, and expenses. One firm stepped forward. Protégé Partners selected 5 funds of funds, investment vehicles that themselves hold positions across a variety of hedge funds. In total, the active management side of the bet represented the performance of more than 100 different hedge funds, elite professionals offering what Wall Street considers its finest work. The index fund delivered an 85.4% gain over the 9 years through 2016, averaging 7.1% per year. The hedge fund portfolio returned just 22%. Fund A produced 8.7% total. Fund B returned 28.3%. Fund C returned 62.8%. Fund D delivered 2.9%. Fund E returned 7.5%. Not one of the 5 outperformed the index. 3 of the 5 generated average annualized returns of less than 1%. In his 2017 shareholder letter, Buffett captured the logic in a single equation. If Group A, meaning active investors, and Group B, meaning those who do nothing, together represent the total investing universe, and Group B is destined to achieve average results before costs, then Group A must also achieve average results before costs. Whichever group carries lower costs will come out ahead. That is not a debatable position. It is arithmetic. Financial advisors are not hedge fund managers. The comparison is imperfect. But the incentive structures that govern fund managers actually make this worse, not better. Fund managers are evaluated on near-term performance, not long-term client outcomes. That means they are not patiently waiting for the right opportunity to present itself. They are deploying your capital immediately because holding cash for 2 or 3 years, even when that is the most rational course of action, does not look good for their career trajectory. Their job security depends on appearing active. Your financial security depends on actually building wealth. Those two objectives are not the same. The data supports this clearly. Among active funds, 38% outperformed their passive counterparts in 2025 after accounting for fees, down from 42% in 2024, according to Morningstar's semi-annual active/passive barometer. Over the 10-year period ending in 2025, only 21% of active funds both survived and outperformed their benchmarks. 21%. The other 79% either closed, were merged into other funds, or simply underperformed. And every single one of them collected their annual fee throughout the entire period. Every dollar that exits your account as an advisory fee is a dollar that never compounds. It does not simply cost you that $1. It costs you every dollar that dollar would have grown into over the next 10, 20, or 30 years. The drag is invisible on your monthly statement and enormous across a lifetime. By year 9, Marcus had begun quietly restructuring his conversations with his more financially sophisticated clients. He was not encouraging them to leave. He was steering them toward lower-cost underlying fund options within their existing portfolios, replacing actively managed mutual funds with index-based ETFs, and reducing internal expense ratios. His clients were still paying the same 1% advisory fee, but their total all-in cost was declining. His book of business grew more slowly than the firm average. His managing partner called him in to ask why he was redirecting clients toward lower commission products. Marcus had been effectively making himself worth slightly less per dollar, managed by routing clients away from revenue-generating products. He left the firm 18 months later. This is where the story takes an unexpected turn. This is also the moment to slow down because there is a legitimate counter-argument to everything presented so far, and the industry makes it effectively. It deserves to be taken seriously before examining where it quietly breaks down. Vanguard, the same institution that pioneered the index fund and served as the institutional home of John Bogle, has produced research since 2001 suggesting that an advisor using their advisor's alpha framework can add up to or even exceed 3% in net annual returns to client portfolios. 3% above the advisory fee. On the surface, that is a compelling argument for paying 1% in exchange for 2. Adding potentially 100 to 200 basis points of value on average, Vanguard identifies behavioral coaching as among the most important contributions an advisor can make, helping clients avoid emotionally reactive decisions, especially during periods of market turbulence. Tax-efficient investing, disciplined rebalancing, and thoughtful withdrawal sequencing round out the remaining sources of value. According to Vanguard's framework, the greatest contribution is not market outperformance, but guiding investor behavior and aligning strategy with actual goals. That framing reflects something real. Investors who manage their own portfolios often lose approximately 1.2 percentage points annually due to behavioral errors based on observations across the decade ending in 2024. If you liquidated everything in March of 2020 and then re-entered the market in June, an advisor who talked you back from that decision may have earned several multiples of their annual fee in a single conversation. That is a genuine value proposition. But here is where the argument begins to unravel. The premise that investors lack behavioral discipline and that financial advisors are the solution is what the Vanguard paper argues. It is what every AUM fee advisor will tell you when the fee question gets pressed. The actual problem is something different. A 1% annual fee is not merely a cost, it is a constant source of cognitive pressure. When you are watching $10,200 per year, or $16,500 all in on a $1 million portfolio once fund expense ratios are included, leave your account. You feel every dollar as a missed compounding opportunity. The drag is not only mathematical, it is psychological. Investors in high-fee arrangements tend to monitor their performance numbers with more anxiety, not less. They constantly calculate whether the arrangement is worth the cost. They second-guess the strategy more frequently. The fee that supposedly purchases behavioral coaching may actually be generating precisely the anxiety it claims to address. There is also a second dimension to this reversal. The behavioral coaching benefit is almost entirely accessible at no ongoing cost. Fee-only financial planners who charge by the hour, well-researched books, low-cost robo-advisors, direct educational resources like this one. The idea that calm, rational investment discipline is exclusively available through an ongoing 1% annual contract is not supported by evidence. It is what the industry charges for. Those are two different things. First comedic moment. The actual pitch made literal. You are emotionally reactive with money. So for the next 3 years, we will charge you $30,000 to remind you not to panic. The panic may be partially triggered by watching that $30,000 leave your account each year, but do not focus on that. Noticing fees is precisely the behavior we are working to coach you out of. A used car dealership has better incentive alignment. Once the behavioral coaching argument is set aside, what remains is tax planning, estate coordination, and periodic rebalancing, all genuinely valuable services, none of which actually require a percentage of your total assets as a pricing mechanism. A $3 million portfolio at traditional AUM pricing of 1% costs $30,000 every year. The identical portfolio managed through a flat fee advisor might cost between $5,000 and $10,000. The quality of the tax planning does not become 3 times superior simply because you hold 3 times the assets. Hourly financial planning rates run between $240 and $400 per hour, and comprehensive financial plans with flat fees range from $7,500 to $55,000 as a one-time engagement. One time, not annually, not compounding against you indefinitely. For the vast majority of investors in the accumulation phase, people in their 30s, 40s, and early 50s who are still building wealth, an annual retainer of $3,000 to $5,000 with a fee-only planner covers nearly everything an ongoing AUM relationship covers, minus the scale problem. To make this concrete, consider someone to be called David, 44 years old, software engineer based in Austin, Texas, who has been contributing since his early 30s. By 44, he holds $400,000 in his 401k and $120,000 in a taxable brokerage account, $520,000 in total. 2 years ago, David hired a financial advisor at 1% AUM. The advisor placed him in a diversified mix of actively managed mutual funds with internal expense ratios averaging 0.7%. David's total all-in cost is therefore 1.7% per year. He receives 2 formal meetings annually and access to a financial planning portal. He believes he is getting fair value because the market is rising and his balance is increasing. Here is what David does not know. When you include fund expense ratios and platform fees, the total cost can reach around 1.65% to 1.7% per year, or $16,500 annually on a $1 million portfolio. David is at 1.7% total on $520,000. That is $8,840 per year exiting his portfolio, measured against a benchmark of 0.03%. His comparative cost to the low-cost alternative is approximately $8,690 per year in excess drag. Over 20 years, the compounding difference between 1.7% all-in and 0.03% all-in on a $520,000 starting balance at 7% gross returns is approximately $240,000 in compounding losses. That is more than his entire taxable brokerage account gone. And David's situation is not complicated. One employer, no business interests, no estate planning issues, straightforward tax situation. He is in the accumulation phase. The advisor is doing almost nothing his portfolio would not accomplish on its own with a properly structured index allocation and annual rebalancing. But the quarterly deduction goes out quietly, slightly reducing the base that compounds the following quarter, still paid by the pound. The advisor is not a bad person. He is doing exactly what his business model demands. David simply does not know he has a choice. Second comedic moment. Imagine a physician who charges you 1% of your total net worth annually for a routine physical. Heart looks healthy, blood pressure is normal, markets are up, you are free to go. The following year, if your income increased or your business had a strong quarter, the bill is higher. The doctor's expertise has not grown. Your health has not become more complicated. You simply hold more assets. A major medical association would never sanction this billing model. The SEC, with certain qualifications, is largely comfortable with it. 3 practical takeaways specific to this topic, not generic portfolio diversification guidance. First, before your next advisory review, request a complete breakdown of your all-in cost. Not just the advisory fee in isolation, but every fund's internal expense ratio, trading costs, and platform fees. Then compare each holding to its direct index equivalent. If the total cost difference across the portfolio exceeds 0.5% annually, you are paying for active management and almost certainly not receiving the returns to justify it. In 2025, only 38% of active funds outperformed passive peers after fees. Ask your advisor which category their fund selections belong to.